It's a pleasure for me to welcome my guest to the show, Drew Clayton, a securities attorney with the law firm of iCard Merrill. Welcome to the show, Drew.
Thank you, Mark. Good morning.
Good morning to you. To start, tell us a little bit about yourself, starting with where you're from, where you went to school, and how'd you wind up here in Southwest Florida?
How much time do we have? I am a 30-year attorney. I've been living in Florida since 1992. Before that, I practiced law in New Jersey. I actually have a background in the securities industry, which is why I do the kind of work that I do. Before I went to law school, I worked for Oppenheimer Mutual Funds in New York starting in 1982. I became a retail stockbroker with L.F. Rothschild, Unterberg, Tobin, and then Smith Barney. And although I didn't really intend to practice law originally, I planned to go into investment banking. I figured that when I was studying for the bar that I would eventually work my way back into investment banking if I decided to practice law first. 30 years later, I think I'm going to stick with practicing law.
I hear you. A lot of us explore avenues outside of the law as well. But so based upon your background, that gave you a good foundation for what you do now. So tell us a little bit more about what type of law you're practicing right now.
Most of the cases that I focus on have something to do with the investment industry or investments gone bad. For the past 30 years, while I've also been engaged in a lot of business litigation, my wheelhouse is really anything that involves finance and investment. So, for instance, many of the cases I've had, and I've had literally hundreds of them over the years, have involved the major brokerage firms like the Merrill Lynches and the Smith Barneys and the Morgan Stanleys and so forth, as well as a lot of the smaller ones. And my clients in those kinds of cases are typically retirees, most of them here in Florida, some in other parts of the country from time to time. And most of them have lost some substantial portion of their portfolio through either poor investment advice or less frequently outright fraudulent investment advice. I also am involved in what are referred to as intra-industry disputes as well, where I'll represent people who work in the industry with claims against their brokerage firms. But I would say that probably 85-90% of my securities-related practice is representing retirees in those kinds of cases.
So before I get into some more detailed questions, I want to play a short clip from a TED Talk presented by award-winning inspirational speaker Matt Weinstein, who's very successful to the point where he's able to vacation in Antarctica. So here's the clip.
This past December, I went on vacation in Antarctica on this ship, the Academic Yuffie, a Russian icebreaker, and it was an incredible voyage. Gorgeous icebergs like floating works of art and penguins running around all over the place and just spectacular scenery. And about halfway through the trip, I got a page to go up to the bridge for a satellite phone call, and I thought I knew what this is about. Before I left on the trip, I had been working with a speakers bureau on a series of dates, and they were supposed to call me if they needed my final approval on the deal. So I went kind of running up towards the bridge, up this steep flight of stairs, because I knew these satellite phone calls were $10 a minute. And at the same time, I'm thinking to myself, this is kind of cool, doing business in Antarctica. But when I pick up the phone, it's not the speakers bureau. It was, in fact, my wife, Janine. And she said a few words to me that just totally turned my world upside down. She said to me, Bernie Madoff's been arrested. His entire fund is a complete scam. And what she didn't have to say, but which both of us knew very well in that moment, was, we had just lost our entire life savings. I felt really sick inside. Janine and I had both started out with nothing, worked really hard for 30 years, built up our retirement fund, given it over to Bernie Madoff to invest. He was the former chairman of the NASDAQ. What could be safer than that? And it was gone, just like that. Turned out Bernie Madoff stole $65 billion. Not all of it was mine, however. But it turned out to be the biggest financial scam in history, totally dwarfing anything like Enron or WorldCom. We both were really anxious about the future. We didn't know if we could afford to keep living in our house. Just everything was up in the air.
So the reason I played that clip because I thought that can better portray the trauma that a client goes through. So let's talk about it first from an emotional level. The first time you're meeting with a client, how do you deal with that? How does this start off as this initial consultation with someone who's maybe lost everything?
It's very difficult to really adequately gauge the significant emotional impact that people go through. I remember in college there was a psychology course, and they talked about Maslow's theory of hierarchical needs. And if you recall that among the most important needs are food and shelter. When you take people's life savings and you either lose all of them or lose some substantial portion, particularly retirees who are not going to be able to replace that income, the emotional impact is devastating. And what I see over and over again, particularly, we are seeing the passing of the World War II generation, but as was very typical of that generation, and is still fairly common today among retirees, the husbands, more often than not, have taken control of the finances, and when they lose substantial amounts of money, not only are both members of that household devastated emotionally, but the person who is most responsible, typically it's been the husband in the cases I've had, the husband is ashamed of what's happened, and they feel like they've really, that they have somehow failed in their duties to provide. And so the emotional impact is extraordinary.
And, I see a similar thing in the bankruptcy because at some point, especially with the older generation, they're taught you pay your bills, and the sense of failure and embarrassment. I can never go to church again. I can never talk to my family, not knowing that they unknowingly know many people have gone through this. But obviously, this is something that has happened outside of their control, and as in the clip we heard, I mean, Bernie Madoff was head of a financial trading entity. How could you not trust him? And it seems like one of the biggest reasons that I can tell, and I'd like to get your thoughts on, is that there's this great deal of trust that's turned over to this financial advisor. Is that the biggest reason these people fall, or are there other things too?
Oh, absolutely. I mean, just as you would imagine, when any of us go to our doctors, we're expecting our doctors are putting our interests first. When people go to their lawyers, they're expecting their lawyers to put their interests first. And the same obviously holds true of financial advisors. And when you look at all of the advertising, and I mean every bit of advertising for the financial services industry, it is all premised on the idea that you can trust the honesty, the integrity, the competence of these financial advisors. And so when people have lost money, either because of the negligence of their advisors or the fraud, it's a devastating thing for them to come to terms with. So trust is the foundation of all of that.
And so in the cases that you see, is it more negligence or fraud, or what's the predominant area?
The vast majority of it is just negligence. Very often it's a financial advisor who at some level has their customers' interests at heart, but has structured their portfolio improperly. And I'll give you some examples a little bit later, but that's by far and away, I think, the most common. Now, there are certainly occasions when financial advisors are actually ripping people off intentionally, but I would say that's a relatively small proportion of the cases, though.
I can remember one financial advisor I had in New Jersey telling me, when TWA is at $4, buy more, buy more, buy more. And we know that TWA isn't around anymore. So, and I've never had a financial advisor tell me to sell something. So always buy more.
There's a lot of research out there that shows that when you are looking at broker internal research reports, about the most negative they'll get is to tell somebody to hold an investment. It's very rare that they'll tell someone to unload something. But obviously there are times when that's good advice.
And I guess the beauty of Madoff's scam was, heck, I mean, they kept making money. So, really more of a reason not to look at your statement. As long as it keeps growing each month, it just further feeds into that trust and that dependence.
Madoff is kind of that's a unique situation. We had one similar here called the Nadell Moody hedge funds, which were sometimes known as the mini Madoffs. They lost about $160 million, as opposed to Madoff's funds losing about $65 billion. But what made Madoff particularly unique is that he created phony statements for some extended period of time, and that's what drew more and more people into the scam, turned it into what's known as a Ponzi scheme, where new investors' money is being used to pay off the older investors.
So give me an example of the typical client you'll see here in Southwest Florida, and what you can do to help, and what's available to help them as far as funds.
We have a very well-to-do population here in Southwest Florida, and so it's not unusual for me to have a client coming in with perhaps as much as $1 million or $2 million in their portfolios. Not always that much, but it's not an uncommon situation. And let's say they retired at the age of 65, and they've bought a townhome, and they're looking to settle down and live off of their retirement income in addition to whatever Social Security or possibly pension they've got. And so they go to a broker that they probably met at a seminar somewhere, or maybe recommended by a friend.
Free dinner.
There free dinners. There is no such thing as a free dinner, it turns out. But in any event, but they'll meet these folks, and they'll get a recommendation to invest their money in a way that very often turns out not to have been very wise. One of the most common types of cases that I have seen over the many, many years I've been doing this are referred to in this line of work as asset allocation cases, meaning that you've heard the old expression, don't put all of your eggs in one basket.
Sure.
Well, the same holds true in the investment market. And I've had a bunch of cases over the years where retirees were put 100% into high-risk growth stocks, and that when the market turned, they lost their shirts. The market went through a huge correction back in the 2000-2001 timeframe called the tech wreck. And we had a bunch of cases coming out of that market, exactly like what I'm talking about here. And we're talking about retirees who lost 60, 70, 80% of their portfolios, which is devastating. After the 2008 great financial crisis, we saw more of the same. And so even though I think the brokerage firms have gotten better at trying to detect those kinds of problems, we still see enough of it to be concerned. We also have cases, and so getting back to the asset allocation concept, it makes sense for people to diversify their portfolio in terms of the types of asset classes that they've got their money in. So by way of example, a 65 or 70-year-old retiree might want to have 10% of their portfolio. This is just very generalized advice, but maybe 10% of their portfolio in a cash or cash equivalent, perhaps another 40% or so of their portfolio in some sort of a laddered portfolio of fixed income. And I'll talk about what laddering means in a moment. And then perhaps the balance of it in a variety of equities spread out over a number of different industries. So you're diversifying in terms of asset classes and also diversifying in terms of the types of companies that you're investing in. So you might have some defensive stocks, utilities, something paying a good dividend. You might have a little bit of growth. I say a little bit of higher risk growth stocks as part of that portfolio, but you're spreading the risk out. I've had cases over the years where retirees have actually been put on margin, which means that they've been induced to borrow money on margin from a brokerage firm in order to buy even more stocks, and that has the effect of leveraging their risk. If the market goes in the right direction, they can certainly make some good money, but when it goes in the opposite direction, it's devastating. So that's a fairly typical situation. We've also had cases involving recently there's something called a real estate investment trust, which is a way of investing in real estate. Some of those real estate investment trusts or business development corps, they're called BDCs for short, many of the ones that we run across are non-trading. In other words, they don't trade on a public market like you would have with a well-known stock like an IBM or something. And so those non-trading REITs and BDCs present a real problem. I recently filed a case for somebody who had about 95% of their portfolio in non-trading REITs and BDCs. Wow. He can't get to his money. He can't sell this stuff. And so that lack of liquidity presents its own risks, for particularly, if you need to replace your roof, you have a big medical bill you can't pay. Not being able to sell your investments is another type of risk that we run across from time to time.
And you kind of reminded me something I remember from years ago when I was in New Jersey when equity was, growing in people's homes. You'd have an investment advisor who was also maybe an accountant, an insurance person, and say, hey, I can get you a second mortgage. We can take that out and invest it in a REIT, and you're going to make all this money. And then the market goes, not only do you lose the equity in your house, you lost it on your investment, and just a real nightmare.
It was a real problem. In fact, it was such a significant issue that the securities industry, which is self-regulated by, among others, the Financial Industry Regulatory Authority, known as FINRA. FINRA came out with some guidance a few years back warning brokerage firms and their reps to be very careful about putting people's money or using their home equity to invest, because it really does increase their risk considerably.
Yeah, and that's why, I see stories about millennials using their home equity to finance a vacation. It's just, you just want to slap them up the side of the head and say, what are you thinking? But that's what we're inundated with today is, enjoy it now and don't worry about it later. But obviously at some point in time, we have to pay the piper. So we'll be back after a short break, and Drew will answer your questions and share more tips and tools to prevent your retirement funds from a financial disaster. Hi, I'm Mark Martella with iCard Merrill. For over 60 years, the attorneys at iCard Merrill have been providing legal counsel to individuals and small businesses in Southwest Florida who need help when life happens. From real estate to estate planning, divorce to personal injury, bankruptcy to starting a business, the attorneys at iCard Merrill stand ready to guide you through the legal challenges in your life. While we have over 30 attorneys spread through offices in Charlotte, Sarasota, Manatee, and Lee counties, we are committed to provide each of our clients with the personal touch and compassion instilled by our founders. For more information on all our practice areas and attorneys, please visit our website at icardmerrill.com or give us a call at 941-206-3700. That's 941-206-3700. Remember, the attorneys at iCard Merrill are here to help you when life happens. Welcome back to Money Matters, your place for financial sanity and serenity. I'm your host, Mark Martella, and I'm joined by securities attorney Drew Clayton with the law firm of iCard Merrill. If you have a question for Drew or myself, give us a call at 206-1580 or toll free 888-441-1580, and you can email your questions to me at mark@markmartella.com. So, Drew, let me ask you this. So I'm sitting here thinking with my attorney hat on, and I don't practice in your area, but my guess is the first defense that somebody raises is that, hey, there's risk involved, and it has nothing to do with being negligent. It's the risk of the investment. How does that get approached?
Well, you're absolutely right. I mean, in every single case I've ever seen, I'll see a defense raised like, well, everybody knows going into the market that you can lose your money, and that's just an accepted risk. And so what are you complaining about? Of course, that defense falls pretty quickly when we start to show that people didn't assume the risk of getting bad financial advice.
And we have a call here. Caller, you're on the air. Welcome to Money Matters.
Hello?
Yes, caller, go ahead.
Hi. I had a question about a fixed annuity. Are those good?
Well, they certainly can be. A fixed annuity is an insurance product. And so the issue that one wants to look at is what are the terms of the annuity? Is it an annuity that lasts for your lifetime? Is it an annuity that lasts for a period of years? What's the interest rate, and who's the issuer of the annuity? So those are some of the things that would have a bearing on whether it's a good annuity or not. But as a general matter, a fixed annuity is considered a relatively safe type of a place to put your money.
Is it something good for someone that's in their 70s at this stage of their life to, like, trying to diversify what you were talking about before, your portfolio?
It can be. The reason I'm hedging a little bit on that answer is I don't know enough about the details of your annuity, and I'm sure we won't be able to get into it over the air today. But what I would say to you as a general matter, it's you can sort of look at an annuity. It's a little bit like a certificate of deposit in the sense that it's going to pay a fixed rate of interest for a certain period of time. One of the issues that we've seen, there's another type of annuity out there that is issued by an insurance company, but it's a security, and it's called a variable annuity. And a variable annuity, that the amount of money that someone can make on a variable annuity is going to depend on however it has been set up. So many variable annuities, by way of example, may be tied to the performance of the Standard & Poor's 500, as opposed to a fixed annuity, which will pay you a fixed rate of interest of, I'll give you an example, it might be 3% or 4% or some such number. So it's a little hard to say whether it's a good idea or a bad idea. The other issue that I think is important to look at when it comes to annuities, whether they're fixed or variable, is whether or not it makes up a really big portion of somebody's portfolio. I've represented people over the years who've had a substantial portion, in some cases 100%, of their available investment funds tied up in an annuity, and that may be a very bad idea. In fact, it usually is, because you can't really sell an annuity very readily. You might be able to liquidate it, but you're usually going to pay a big surrender charge. With a fixed annuity, you might not be able to liquidate it at all. So there's a number of different factors involved. But at first blush, it may be okay, but honestly, it takes a further analysis to figure out whether it was a good thing for you or not.
Okay.
Thank you for the call. Thank you.
You bet.
So, Drew, how about some tips about choosing a financial advisor? What should people do in making that determination?
I ordinarily encourage people to interview at least 2, preferably 3 different financial advisors. It's kind of like feeling comfortable with your doctor or your lawyer. Not everybody is going to gel with every financial advisor they meet with. So meet with 2 or 3. And when you meet with those people, try to have an idea about what your particular investment objectives are. When you open a brokerage account, the broker that you deal with has got to fill out a new account application, and that new account application is going to seek information about the investor, which will include what that investor's investment objectives are. And I've met with a bunch of people over the years who will say, well, I'll ask them, well, what was your objective when you opened the account? I wanted to make money. Well, of course, everybody wants to make money. But when I'm talking about investment objectives, are you looking primarily for income? Are you looking for growth? How much risk are you willing to take? Are you the kind of person who may lose sleep if you start to lose money in the market? How long do you need to have this money invested? So are you looking to do something with it in particular? Try to help fund, let's say, some of the college costs for your grandchildren. I mean, everybody's got their own particular objectives, but it's very important to give thought to those objectives before you meet with a financial advisor. And then sit with the financial advisor and say, look, this is what I think I need to do. What kinds of things might you suggest? And listen to what the financial advisor has to say. Now, there's a great resource available through the Financial Industry Regulatory Authority website, and it's called FINRA, FINRA.org. Again, FINRA, FINRA.org. And on that website, you'll see on the landing page on the upper right-hand corner something called Broker Check. Broker Check is a tremendous resource. You put the name of the financial advisor in that box, and it will give you a synopsis of that advisor's history in the industry. And that will include things like how long they've been licensed, what states they're licensed to do business with, which brokerage firms they've been employed by, and, very significantly, whether there have been any customer complaints brought against them and any regulatory actions. Really important to check that stuff out, because that will certainly give you some insight as to whether you're dealing with somebody who maybe has some questionable background.
That sounds like a great resource, and we'll put that up on our website at markmartella.com. That's the Money Matters website. Go to our resource page, and we'll have that for people to use. So after you've chosen your financial advisor, you've given them your hard-earned money, what's a good practice to make sure they're doing what they're supposed to do?
One of the things that I have seen over the years, and it never ceases to amaze me, having represented people with a great deal of money invested, certainly very often all of their life savings, which is always a great deal of money, but people who have invested anywhere from hundreds of thousands to millions of dollars don't look beyond the first page of their statement to see what they're actually in. So first and foremost, make sure you look through your statement each month, every page, and ask questions if you don't understand what's going on. One of the biggest challenges that I think investors have is that the investment markets are very, very complicated. We've touched on just a small sliver of the types of investments. We've talked in broad terms about stocks. We've talked a little bit about fixed income, which would be bonds. The caller just a moment ago talked about an annuity. But there's many other variations on those themes. There are mutual funds. There are exchange-traded funds. There are options. There's all kinds of stuff out there, all of which within each of those categories has its own complexity. So it's not unusual for investors to really not have a good handle on what they're investing in. So it's very important to look through the statement, and if you don't understand what's on those statements, ask questions about it. Really key. The other thing I would suggest is that people should try to make sure they meet periodically, if they can, face-to-face with their financial advisor. I would say every 6 months, and certainly at least every year. Financial advisors are expected to meet with their customers.
So don't they have a duty?
They do. They have a duty because people's financial circumstances change. There's a rule in the industry. It's called the suitability rule, and what that basically says is a financial advisor has an obligation to make recommendations. If they're going to make recommendations at all, as opposed to just being an order taker, if they're going to suggest to somebody how they should invest, then they should make those recommendations appropriate in light of somebody's financial circumstances and needs. That's called the suitability rule. So it's important because people's situations do change.
Okay. So they should be reviewing their statements.
Absolutely.
What happens if they think something's not kosher?
Well, they need to pick up the phone and call their financial advisor. And if they really aren't persuaded that what they're seeing or what they're hearing from their advisor makes sense, they should talk to the branch manager of that advisor's office. They can always pick up the phone and talk to the branch manager. One of the principal responsibilities of the branch manager is to make sure that the advisor is playing by the rules.
So I'm looking at my statement and the market is doing well, but I'm not doing as well as I think I should, or I'm going down. Where do you draw that line between just, again, the volatility of the market versus, hey, I'm not being advised properly?
Well, as you might imagine, over the years, and I've been involved in, as best I can tell, probably 700 or 800 of these cases over the years. Wow. No one comes to me unless they think they've lost money. So losing money in and of itself, though, is not a sign that there's a case. The real sign is whether or not someone's accounts were invested in a way that was suitable in light of their financial circumstances and needs. So when we see elderly retirees who can't afford to lose money, at least to any significant extent, if they're 100% in the stock market and worse yet on margin, then we know right off the bat that we have a suitability issue. If we see somebody who has been put in highly illiquid investments and it eats up most, if not all, of their investable assets, once again, we know that we've got something. So losing money alone isn't the key. It's seeing what the cause of the loss is.
And the analysis would be different from a 35-year-old to a 65-year-old.
Sure, absolutely. It changes. As people get older, depending on their income, their assets, their debt levels, all that stuff factors into it. So a lot of shades of gray.
And you're pretty busy with this work.
Have been busy throughout my career.
So somebody's been listening to the show. They have some questions. How can they get in touch with you?
Well, they're certainly welcome to give us a call. I'm located in the Sarasota office of Eichard Merrill. And that telephone number is 941-366-8100. That's 941-366-8100.
Okay, great. And again, you're located in the Sarasota office. One last tip that you can give to our listeners.
Learn. Try to educate yourself about what it is that you're investing in. As I mentioned a moment ago, when you look at your statements, if you don't understand something, ask questions. But better yet, try to understand what it is that you're investing in before you put your money there. It'll serve you well. Because
you still have your own responsibility to take a look at things and don't just pass it off to your investment advisor and expect everything to be hunky-dory.
Absolutely. You don't have to be an investment expert to be a customer, but it really makes sense to invest a little bit of time to try to understand what it is you're putting your money into.
Great. Well, Drew, thanks again for joining us. I want to thank all of you for listening to us. Again, if you want to reach Drew, you can call him at 941-366-8100 and ask for Drew or his assistant, and they'll be happy to help you out.